WTI retreated the $85 per barrel this week as US crude oil inventory data showcased a larger than expected buildup of reserves. Oil traders continue to grapple with conflicting fundamentals of OPEC Plus supply cuts, European Union's embargo on Russian oil, and the deteriorating demand outlook from China, which continues to enforce its draconian zero-COVID policy plans. Moreover, growing fears for a potential global economic recession supported by the aggressive monetary policy tightening practices of various central banks inject additional uncertainty in the equation. In this report, we aim to shed light on the catalyst driving WTI's price, assess its future outlook, and conclude with a technical analysis. Today, the markets anticipate the crucial US CPI print for the month of October, which will provide valuable clues as to where the inflationary problem stands in the US economy. The year-on-year headline rate is expected to slow down to 8.0% from the prior month's 8.2%, and if actually so, may enhance market expectation that inflation has peaked and is slowing down, which in turn may incentivize the Fed to decelerate its aggressive rate hiking path. On the flip side, however, we must note that the month-on-month rate is expected to accelerate to 0.6% compared to September's 0.4%, and if actually so, may be implying that inflationary pressures are still simmering under the surface. Such a scenario in conjunction with the fact that even though the headline rate may slow down to 8.0%, is still a far cry from the Fed's target of 2.0%. Therefore, it may not allow central bank to ease its hawkish stance. Last week, the Fed raised its federal funds rate to 4% as central bank hiked by 75 basis points for the fourth consecutive meeting in an attempt to curb broad inflationary pressures in the US economy. Also a positive employment report, with the exception of the uptick of the unemployment rate, practically reassured the view that there is still room for further hikes. As a result, the prospect of even higher interest rates weighs on demand outlook of oil as the effect of the Fed's aggressive monetary policy practices contributes to the slowdown of economic activity in the US economy and increases odds for global economic recession. On another note, the US crude oil inventories pointed to a decrease in oil demand during the past week, as the EIA yesterday reported a larger than expected rise of 3.9 million barrels in US inventories, despite expectation for a buildup of only 1.360 million barrels. Furthermore, the API weekly crude oil inventories figure reported on Tuesday also pointed to an oversized buildup exceeding estimates by 5.6 million barrels for the same period. The expectation was 1.1 million barrels. The buildup of inventories in both readings explains the recent slump in oil prices observed during this week. Moreover, we would note that last Friday, Baker Hughes oil rig count showed the number of active oil rigs in the US has risen by 3, reaching a total of 613, which can be an indication of increased demand levels. On another note, the EIA latest short-term energy outlook report stated that uncertainty in macroeconomic conditions could have a significant effect on energy markets going in 2023 as the S&P Global Macroeconomic Model forecast US GDP to ease slightly next year, contributing to a drop in crude oil consumption. As the finance ministers of the G7 group are set to finalize the price cap plans of Russian crude on December 5th, Russia is reportedly seeking to divert its flows from the European continent, embarking on journey east, having inside countries such as India, Turkey and China. The embargo in sense seeks to restrict excessive revenues from the sale of Russian crude flowing back to Moscow, which are being used to fund the prolonged war in Ukraine. Analysts expect that Russia won't likely to be interested in participating in deal under such terms and could in turn walk around the embargo. Recent reports surfaced show that India is to become one of Russia's biggest buyers, capitalizing on the excess supply left in the global markets. Data for the months of September and October indicate that India's crude oil imports from Russia started to increase, squeezing out more expensive inflows from Saudi Arabia and Iraq, which have been supplying the world's fastest-growing emerging economy in recent years. India's foreign minister commented that it is the government's best interest to ensure consumers have access to international markets with the best possible terms, and in that respect, quite honestly, we have seen that India-Russia relationship has worked to our advantage. The world's second largest economy and manufacturing powerhouse China dismounted any hopes for loosening of its strict zero-COVID policy stance this week as COVID outbreaks resurge across its major cities. Hopes for a gradual reopening, which could spark a rebound in energy demand, were practically subdued as authorities maintain their tight grip. That, as consequence, intensifies market worries since the slowdown of manufacturing activity of the Chinese economy alongside the lockdowns could foreshadow an impending recession, which could split over the international scene, which could intensify market worries for the demand side of oil. Thank you for watching.